Hello and welcome to another episode of Darwin Investors. Man, what happened last week? I feel like I come on here every week and ask that same question. I mean, it didn't seem like it was going to be so bad. We got commodity prices that are crashing. We had a job openings report that seemed pretty good. We had an unemployment report that was considered Goldilocks by a lot of stock analysts. I mean, it was like we were set off on this voyage out in the Mediterranean on the Costa Concordia, only to find us crashed in the rocks off the coast of Italy. So what happened? Well, in this episode, what we're going to talk about is the things driving the market was the inflation rate and the bond yields. And what we're going to do is we're going to try and predict where the inflation rate will be in the spring of 2023. And then we're going to show what sort of impact that will have on bond yields. And last, what I'm going to do is I'm going to talk about certain stocks that I really like that are growth dividend stocks, because I think what's going to happen is the narrative is going to switch from inflation to bond yields. And then the narrative is going to become what stocks are out there that give you growth and also have a dividend yield that's pretty much the same as the 10-year note. And so that's what we're going to get into today. I'll show you a stock screener so you can screen for your own, and I'll give you a couple that I really like. So let's go ahead and get into this. But first, let's have a word from my sponsor. Guys, do you not go to the bathroom enough? Do you sometimes have trouble telling your best friends that you love them? Well, if I ever got the product for you, that's right, it's beer, my sponsor this week. I gotta admit, I'm feeling the love already. Please like and subscribe. Now let's get into this. Now, as we all know, commodity prices have been coming way down. We know that every time we go try and fuel up at the pump there. The price of oil went from a high in June of about $122 a barrel to a closeout yesterday of $86.87 a barrel. It seems to be range bound like between $85 and $100 depending on COVID shutdowns in China. That seems to be what keeps this thing down. Also, we've got the price of lumber coming down from about $1,300 in March all the way down to a closeout yesterday of $476 yesterday. So that's come way down. So we expect the price of building homes to come down as well. We had the wheat futures come way down since June of this year from $1,277 to a close yesterday of $811. We've had copper come way down in April of this year from $4.82 to a close yesterday of $3.41. We have corn come down since April from $818 to a close yesterday of $669. However, that is up from where it was in July, where it was only $564. So that one's creeping upward. And the other troublesome one might be definitely be natural gas here, which seems to be on the rise. It's kind of the thorn on our side. But by and large, commodity prices are coming down. And because commodity prices are coming down, month-over-month inflation seems to be leveling out. Last month, month-over-month inflation was 0.0%. Economists predict that this month it's going to be 0.0%, and next month will be 0.0%. Because of this, the year-over-year inflation read went from 9.1% down to 8.5%. And so what do we think it's going to be this month coming up in September? Well, they have no prediction yet, but we're going to go ahead and make a prediction based on what economists believe is going to be a 0.0% rise in inflation this month and a 0.0% rise in inflation next month. So the way that you calculate this inflation is you go from July of 22, which was 296.276, and you divide that by the number it was last year, which was 273.003, and you get 8.5. And so when you look at this here, it says the annual inflation rate in the US slowed more than expected to 8.5% in July from an over 40-year high of 9.1% in June. So what would we expect this month? Well, using the prediction of the 0.0% month-over-month increase, we would take this same number, 296.276, and divide that by this August total here of 273.567. So we would expect this month's inflation read to still come in really high at 8.3%. And then we would expect next month's to come in at 8.0%. So we're not really even expecting this to get below 8% at least until around Halloween time. Now, what we're going to do is we're going to predict that every month, instead of this being 0, we're going to say it's going to go up 0, well, it's going to go up 0.2% every month. And it doesn't have to go up. It could actually come down. And I think it will actually go negative through next spring based on the chart that's here. But let's go ahead and call it 0.2% every single month. And why do I think it's going to be negative? Well, look at how sharp this rise is here. So it went pretty flat from here to there. So we would expect this is pretty flat and that's very flat. So we would say between here and this line, unless it comes way down, this is not going to be an appreciable decline in the year-over-year inflation rate. However, it is really sharp through here all the way up to March. And that's why I picked March of this year as to where I believe the inflation topic will really be like, wow, we're really doing a lot better than we were, is in March of 2023. So what I'm going to do is I'm going to plug in a 0.02 every month after September and see what that number would be in March of 2023. And then we'll figure out what the inflation rate would be based on my calculations in March of 2023. So now we're looking at, and this would be kind of like, I wouldn't call this a bear case or a bull case. I would just call this, just I think middle of the road, because I am gonna increase it, even though I don't think it necessarily is gonna increase, but I'm gonna increase it by 0.2% per month after September. 296.276 times 1.002 equals 296.86, and that would be October, November, December, January, February, March. Okay, so we would say that March, by these calculations, would be roughly 299.84. So we divide that number by last March of 287.504. And that gives us a year-over-year inflation rate of about 4.3 in March of next year. Now, how realistic is that? Well, when you look at inflation rates over the course of a long time, you can see that it basically will stay relatively flat. And I'm not saying it's going to come way down here and it's going to be some number down here. It's not going to go magically down to like 260 or whatever. But what I do think is we're going to level out. We're going to find a spot here in the 296 to 300 range that we're going to live in over the course of, say, next year. Or, we're going to live in this range similar to the way over here we lived in 244 in July of 17, and then we were at 252 in July of 18, and then we were in 256 in July of 19, and then we were at 259 in July of 20. And so we're going to live in kind of a range. It's going to be a high range up here, but we're still going to live in this range. And that's where I think that inflation might actually come down to that 2% that Chair Powell is actually looking to achieve. It's not going to come clear back down here. The prices are still going to be elevated, like they are today, basically, but I don't expect them to go straight through the roof. And then when we have inflation under control, the narrative is going to switch to bond yields. So again, looking back at this chart here, we're better to understand this TEF forecast and these numbers of 297. Consensus came in at 296, but actually was 296. And then this month, the consensus is 296. And next month, it appears that the consensus is also going to be 296. And then I've given it little adjustments going forward, which gets us to an inflation rate around low fours by March of 2023. And that's where I think inflation is going. So what's the significance of getting us down to 4% on the inflation rate? Well, that's because the bond yields, they're trying to crank up to about 4%. And what they're trying to achieve is a real return on bonds of 0%. Let's look at some of the stuff that came in last week. The Tuesday, August the 30th, job openings topped 11.2 million in July. You would think that that would be good because it shows that there are two jobs for every one person looking for a job. But if you're in this funny world of the stock market, this is considered bad news. And the reason why is because having this many open jobs, more than we have available workers, is an inflationary sign that the US labor market is still extremely tight. And since we're trying to battle inflation, it means that we have to raise rates. As we said earlier, we had this, what they call the Goldilocks jobs report that came in yesterday. The August employment report paints a very positive picture regarding the current state of the US economy, with solid jobs growth, yet signs that supply strains are easing as workers return to the labor force. With wage growth coming in lower than expected, it points to a slower pace of rate hikes after September's expected 75 basis point move. Now, prior to this, we were only expecting a 50 basis point move. But when this came in really hot, the 50 point expectation in September at the next FOMC meeting has now turned into a 0.75 basis point hike. So that's what this job openings report did. So we went from 50 points to 75 points. We'll hit the very high points of this article. One thing that they were really happy about was the fact that the jump in worker participation rate jumped from 62.4 to 62.4% from 62.1%. And a lot of these workers were coming from let's just say older workers. You know, these are people that probably were retired. They were coming out of retirement either because their 401ks were awful, their investments were terrible, or they were enticed to come back to the workforce because COVID had somehow waned, or maybe they just got bored. I don't really know, but all I do know is that a lot of these workers coming back were older workers. And they also had a jump in workers in the 18 to 25-year-old range, which could be seasonal, but you'd think that a lot of them would be going back to college, and that number would send it down. In any case, there was a jump in worker participation, and they saw that as positive. And the next thing they found positive is that the wages themselves rose a little less than expected at 0.3% a month versus the 0.4% consensus. So we're having more people join the labor market, and we're finding that the employers are not paying them as much as as what was expected. And this is considered to be disinflationary, not deflationary, but at least it's not causing more inflation than what would be otherwise considered normal. And then the last thing that I want to get into is, this is the most important thing here, is the 75 basis point hike in September, but the pace is to slow thereafter. So what they're thinking is that we consequently expect the Fed to slow the pace of rate hikes to 50 basis points in November and 25 basis points in December, leaving the range for the Fed funds target at 3.75 to 4%. Now, like what I already showed earlier, I am expecting through my calculations that the inflation will be in the 4% range in, say, the spring of next year. And so a lot of these people have this like terminal rate of 4%, and Powell himself has come out and said they expect to go up to 4%, but they don't expect it to bring it back down. I don't think that they're going to bring it down either, but I do believe that once we hit this terminal rate, it's going to steady. And so that's where they're getting this 4% Fed funds rate. It's what they believe they need to get to achieve a net zero return on the 10-year note. So what's going to be the narrative going forward? Well, I think we're going to shift from talking so much about inflation here, say in the beginning of 2023, and we're going to start talking more about these bond yields. Now, what companies do I expect to bounce back first? Well, they're going to be the companies that went down first. So we're probably going to get our growth stocks are going to go up pretty good. And we're going to get tech's going to have a really nice bounce, I would imagine. But I think what's going to be a hot topic is going to be stocks that grow some degree, but also provide a dividend yield that's in this 4% range. And I've got a couple of stocks that I'll tell you that I'm interested in here in the short term, but I'm going to show you a stock screener that'll help you find your own. So I went over here to finviz.com. And I went to their screener right here, and then I just pulled up stuff that I think is important. And so what I'm looking for is I'm looking for a stock that's not overvalued. We'd say it has a forward PE under 20. The S&P PE is right around 17 or something like that. So this puts us right around where the forward PE is of the S&P 500. So we're on par with that because we are looking for something that has growth. We want it to have earnings per share growth of over 5% this year. It's projected to have over 5% next year, and it's had over 5% the last 5 years. These are things that are important to me. I also want to have a nice operating margin of 5% because this means that they can afford to pay their dividend yield. On the descriptive tab here, I want their dividend yield to be over 3%, and I want their average volume to be, say, 750,000 or so. And that's going to basically get me a stock that has some sort of interest on Wall Street. And then I would just hit search, and then it gives me all of these things. And I've got 4 pages of them, or 80 stocks-ish in general. Advanced Auto Parts leads the list. And not all of these are great stocks. Do your own research. I'll just show you the ones that I'm interested in later. But you just go to FinViz, enter the criteria that you find important, and see what stocks it spits out. I'm not very hyped on American Eagle, for instance. Broadcom is funny because it's a semiconductor stock that does continue to go up. So why would Broadcom be the only semiconductor stock that's going up here, at least here recently, when others seem to go down, drop like a stone? Well, it's because they're a growth stock that provides a dividend, something that investors are finding attractive at this moment. Best Buy is not one that I'm super interested at this moment. They may become a Toys R Us or Blockbuster situation with these guys, but we'll see what becomes of them. They may be able to transform their business into some more of an e-commerce type of thing, but it remains to be seen. So I'm not really high on Best Buy, but again, they're on this list. Blackstone is one that would be really good that I'd be very interested in. You can see that this list is full of financial and energy stocks and some consumer cyclicals. Communication services is not one that I'm really generally interested in, although I do see myself selling puts on Facebook going forward to try and generate a little bit of extra revenue because they seem to have a floor about $160. So I'm going to sell these puts just out of the money, naked at about $155. Comcast is not one that I'm interested in. If you think about other communication services stocks such as Verizon or AT&T, these are companies that pay a nice dividend. However, they don't grow, and those are not the kind of stocks that people are going to be interested in. They're going to be wanting the ones that grow a little bit and that also pay a dividend similar to the return on the 10-year note. Darden Restaurants, Duke Energy, Devon Energy, and so on and so on. Energy Transfer. I did actually a video on this one here. I'll leave a link in the description. It'll be in one of these sites. I don't know which one. But I'll go ahead and leave a link in the description to my breakdown of this Energy Transfer. They're a natural gas company. The natural gas field is actually a very crowded little field of companies, but this one trades with a very nice dividend. It's only like $11 a share. So if you could find this one under 10, grab it, because I'm going to grab a whole bunch when I see that again. And again, they're in the natural gas space. So these are the criteria that I look for. A couple of stocks that I'm really interested in that actually meet this criteria. And this is a way to look up some companies that you might be interested, some that provide a nice dividend and give you a little bit of growth to boot. Now, do I expect the 10-year rate to spiral out of control? I really don't. Because I find that the United States bond yield would be similar to other countries. Unless the whole world spins out of control, the U.S. bond yield's not going to spin out of control. So if we're here at 4%, you can see that at 4%, we're pretty much going to be about the highest in the world, with the exception of, say, India, Brazil, and Mexico. And so you would, at 4%, you're going to expect that other countries would want to buy our debt because we're going to return them a 4% yield. And some of these other countries may or may not pay you back, Greece. We're considered a safer bet than that in the long run. So I don't expect that our 10-year note will, even though you hike it up to 4%, is going to spiral up and up and up unless everybody else's goes up and ours relative to the rest of the world looks like a bad deal. So if you follow this channel at all, you'll know that I'm actually kind of bullish on UPS. I like them one now because the price of gasoline is coming down, so transport companies should be doing a lot better than they were, say, a few months ago. They have a nice price to earnings ratio of 15.65, a forward PE of 15.23, meaning that they trade at a discount to the S&P 500. This is something that I'm looking for in a stock. The other thing that I'm looking for in a stock is that they have a dividend yield of 3.1%, and they have a nice profit margin of 10.92% with a growth forecast of 5.61%. So we're talking about a company that's going to grow, it's going to pay you a yield that's similar to the 10-year, and it trades at a reasonable valuation. And these are the sorts of things that I'm going to be into going forward, just at least in the short run here. Until things like really come around and everything starts shooting up again. These are the sorts of stocks that I'm going to kind of like for now. One company that I am liking these days is Advanced Auto Parts. They're currently trading at $171.73 a share. They trade at a price to earnings ratio of 19.78 with a forward PE of 13.19. They have an annual dividend yield of 3.49%, a net profit margin in the 5% range, and a growth forecast in the 10% range. So these are the sorts of companies that I'm looking for right now. Another one that I like is Union Pacific. These guys also, they don't grow a lot, but what they do is they buy back a lot of their stock. They're a transport company. The price of fuel is coming down. So this would be another one that I'd be a little bit bullish on. They do trade a little bit on the rich side at 21 for the price to earnings ratio with a forward PE of 19. Their dividend yield is decent at 2.32%, but they do have a wonderful net profit margin of 29, which allows them to pay this dividend, and you would expect that they would raise that dividend. Another thing they do is they return a lot of equity to their shareholders with buybacks, and that's something that they do with this huge profit margin. And they are expected to grow at 14.64% next year. So this would be another company that I would be interested in. All right, well, that's going to do it for this week. If you've got anything out of this episode, yeah, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a good day. Bye.